Good morning, good afternoon, good evening to all of you. I want to say a big thank you for taking the time to join our webinar on global digitalization of the financial services sector, adapting to a changing world. My name is Doug Landy, and I'm the co-head of the Financial Institutions Industry Group here at White & Case, part of the team that has put together this program for you today. This webinar is part of our World in Transition series, where we present issues affecting our clients across the sectors and geographies in which they operate. There's clearly a lot of change happening in the world, and the rate of change has accelerated faster than most of us have seen in our lifetimes. The webinars and thought leadership we produce as part of the series will hopefully provide our clients with the support to understand these complex issues. Today, we are discussing the role and adoption of technology in our financial system. Almost daily, we are faced with questions about how technology will be used in the delivery of financial services. It's often difficult to keep up with the new technologically driven innovations and the debate as to how, where, and when the regulation of technology and financial services should begin and end. I'm excited to hear from our speakers on the panel today, each of whom have significant experience in these areas and bring their own unique perspectives on these questions. Before I introduce the moderator who will introduce our all-star panel, a couple of housekeeping points. We'll be taking audience questions, and these should be submitted using the Q&A function. If you experience any technical issues, please email whitecaseevents@whitecase.com. As a reminder, this webinar is being recorded and a copy will be made available after the event. Finally, you hopefully should be able to see an animation of the session on your screen. The animation is being created live and will document the ongoing discussions. We'll be returning to this during the session and sharing it with you after the webinar. I would like to welcome and introduce you to Stephanie Flanders, who will be moderating the session today. Stephanie is a British economist and journalist, currently head of Bloomberg News Economics. Previously, Stephanie was the chief market strategist for Britain and Europe for JP Morgan Asset Management. And before that, the BBC News economics editor for 5 years. Over to you, Stephanie.
Thank you very much, Doug. I guess given the events of the last week, we can't say it's the top of everyone's agenda, but I think it's still pretty high, the digitization of financial services. And you're quite right about the all-star panel. We've got some people from private, with enormous private and public sector and legal expertise. And I hope we'll be making that cartoon suitably animated and exciting by the end of this 40-minute session. So let me quickly introduce the panel so we can get into the discussion. Mike Cagney is the co-founder and chief executive officer of Figure. I think he's joining us from San Francisco. He's had decades of experience in the industry, has played lots of different roles, but was perhaps best known before as the CEO and co-founder of Sophie, the marketplace lender. Randy Qualls, fresh out of the Federal Reserve, where he was for several years the first vice chairman for financial supervision. He was also, during that time, chair of the Global Financial Stability Board, so really the global organization that's trying to grapple with these and other crucial regulatory and technology-related issues. Alistair Lukes, CBE, is a very well-known pioneer and champion for the UK fintech industry. He was founder and CEO of Pollinate International, has done loads of things. He's also chair of the Fintech Alliance, and he has the, I hope it's an honour, the joy of being on the UK Prime Minister's Business Council. Finally, we have Anagnosti, who is a partner in the global capital markets practice here at White & Case, and she has made her name in the company talking through navigating the complexities of issuing digital securities on the compliance side for White & Case's clients, and before that was nearly a decade at the Securities and Exchange Commission. So we really do have all perspectives here. Mike, I'm going to give you the honour of kicking us off by just giving us a sense of how you see the relationship between innovation in the financial sector and the banks, and how whether you can revolutionise financial services. When you revolutionise it, are you replacing banks as we might have previously thought, or is there a new way that we now look at it? And what's the regulatory implication of that?
Sure. So I think one of the most important technical advances we've had in the last couple of years has been blockchain. And what blockchain does is two very important things. It allows you to displace trust with truth using native digital assets. So for example, when you originate a loan on the blockchain, all the underlying characteristics of that loan are digitally signed by source and represented in an immutable form. And it allows two parties to transact bilaterally without counterparty risk. So the premise is, if I'm selling you securities or loans or what have you, I'll have them in my digital wallet. You'll have stablecoin in your digital wallet. We face off directly, and the blockchain registers the stablecoin to me and the loans or the assets to you. And the importance of this is when you intersect these two things, you create marketplaces where you become agnostic to your counterparty. And if you think about financial services today, it's built around intermediation. So think about how the exchanges work, the stock markets work. You have in the US DTC sitting in the middle as registrar, and then you have a four-party broker system on introducing and clearing on either side of that transaction to clear trades, because you need this intermediation process. Contrast that to how most crypto trades, for example, on decentralized exchanges, where you have two counterparties that face off directly and anonymously and transact bilaterally. And so you're looking at massive transformation, and you can look at the exchange marketplace, you can look at payments where Visa and MasterCard sit in the middle and act as registrar, and you have a four-party issuing and acquiring bank and processor ecosystem around that. Whereas with blockchain, you can move money bilaterally between two counterparties using stablecoin. And so I think we're at the precipice of a pretty significant transformation in technology, and the banks are going to be very important participants in this technology. I think the key for blockchain is it's a great leveling force. So what it does is it allows small banks to compete with large banks. It allows traditionally disenfranchised consumers to get the same products as well-served consumers. It's a phenomenal leveling force across the market. And so what I think you're going to see is an actual ability for some of the smaller banks, especially the community and regional banks, to leverage this kind of technology and not only be on par with, but in fact, in some circumstances, get ahead of the money center banks in terms of products and services. Obviously, there's a huge amount of regulatory issues that come up with this, and I'm sure we're going to spend a lot of time today talking about that and going into depth. But the basic tenet of what we see is blockchain is going to provide a transformation to these intermediated exchange functions, whether it's how we trade stocks, how we move money for payments through interchange, how we trade loans. And in doing so, you're going to see a significant recapitalization of market cap move from traditional incumbents into technology, either native to the chains or built around the chains. But I think the banks are going to be core to this. And I think, USDF is a great example of this, where a set of regional banks has established a stablecoin token called USDF with reciprocity across their members. And USDF not only is liquidity on the blockchain, it's effectively a 24/7, 365 payment rail that's going to cause a massive reallocation of resources away from ACH and interchange. Unlike FedNow, USDF is programmable. So not only is it real time, but you can actually do things with it you can't do with a real time payment platform. And so, I think the banks are going to be core to participation, but I think it's going to be more of an egalitarian level of participation, at least in the US, than it's been historically, with the money center banks, really dominating and getting more and more market share. This is a potential for that to reverse out.
Well, Doug mentioned I spent a few years at JP Morgan. Of course, what Mike just said is not at all the way that Jamie Dimon would want to see the future for JP Morgan and for the other big banks. But I think even they have had a kind of evolution of how to think about the fintech revolution and how to be a part of that, but not just to ignore and or try and immediately replicate everything that the smaller upstarts, as they would call them, are doing. So Alistair, when you just sort of jumping off what Mike just said, do you think that the best way forward for the big established banks will be to partner with fintechs, or just try and replicate and make the best use of this technology themselves and just use their existing advantages, or is it completely a leveling force the way he describes?
Well, no, I think, and hi, great to see everybody. And I reiterate your comments earlier. There's bigger things happening in the world, so obviously all our best wishes to everybody involved in that. I thought Mike made some superb points, and perhaps blockchain is the first real technology that we've seen that could change some core fundamentals. We have to remember that fintech's not a new thing. It's had a brand name since the global financial crisis, of course, because governments and regulators had to find a new stick to beat the banks with. And in the UK alone, we've had 38 new neobanks issue banking licenses in the last sort of 15 years. Prior to that, it was 250 years. We had 4 clearing banks in the UK. So something shifted and something changed. But fintech's been going on a long time. Mike mentioned Visa and MasterCard. Visa and MasterCard were early examples of fintechs. They just happened to be controlled by the banks. And the banks had the control of the pace of the growth. The banks were the equity participants. The banks were the people that were creating the spaghetti junction below the surface to connect them all together. And for those of you on the on this webinar, if you think about it, you can get off a plane anywhere in the world. You can put a card into an ATM. You can use the same 4-digit PIN. You can get cash out of the hole in the wall. Below the surface, there's a huge amount of infrastructure that's been put in place. So that's not going to disappear overnight. I think to your specific question, there's 2 types of fintech. There are fintechs that want to disrupt. They believe the banks have got it all wrong, that it's hugely frustrating, it's too slow, it's not a great user experience like I get with Spotify or I get with Amazon. But of course, they get so far up to the drawbridge and then the regulation comes in. And I know we'll hear a bit about that in a minute. And then the regulator says, well, that's all very well that your app's fantastic and you're getting a great net promoter score, but do you have enough tier 1 capital to make sure that you don't go out of business because you're looking after people's money? And then there's enabling fintech, where there are companies that see the banks as the regulated entity. The banks are the people that are going to continue to look after our money, but you can provide a new front end. You can create a new shop window into that bank. And so they're 2 very distinct types of fintech. And an analogy perhaps for the audience is, in the early 2000s, mobile networks had built out this huge infrastructure. If you think of Vodafone, Verizon, AT&T, and they believed they were going to rule the roost. They said, if you want to put an app on our phone, you'll come through us. You have to convince us that that's something our consumers want. And then, of course, the iPhone came over the top. And people say, well, you're just the bandwidth, you're just the utility. There's a fair bit of speculation at the moment that the same thing could happen in the banking world. I think it'll be similar to the MVNO model. So Richard Branson would come with Virgin's brand and say, I'll lease some bandwidth from you. I'll take some of your back end capability and I'll do a better job of marketing to customers. I think it's likely we'll see some new brands come to banks and just say, well, why don't you be the bank at the back end, but I'll do a much better job of looking after the customer.
Well, Alistair mentioned the regulatory side, so of course we should bring in Randy Quarles on this. I mean, there's a very lively debate within the Fed. I think we'll probably get on later to thinking about whether they do go ahead with a central bank digital currencies. But on this broader issue of regulation, the President's Working Group for Financial Services at the end of last year did suggest that they were concerned about financial products growing outside of the regulated financial system, specifically stablecoins, and that they should, as they became more potentially a risk for financial stability, they should start to be regulated more like banks. Do you think that is the future, that anything that becomes important enough is, as far as the regulators are concerned, is going to have to start looking like a bank and behaving like a bank?
Well, I think that I think that there are, particularly with respect to stablecoins, but also across the broader issue of technological advancement in finance, there are some clear and legitimate regulatory interests that need to be addressed. With stablecoins, questions about the nature of the reserve that's anchoring the stablecoin's value, the maturity of the instruments there. Is it single currency? Is it multiple currency? These are a variety of financial stability and even monetary policy interests. There are anti-money laundering interests with respect to any sort of a payments technology, consumer protection interests. So all of those need to be addressed, and the type of regulation that will address them will look similar to banking regulation, but I don't think it has to be banking regulation. And what concerned me was that the President's Working Group report seemed to indicate that really stablecoins would have to be issued by banks, not subject to regulation that address the same sorts of concerns that bank regulation addresses. And there's a whole panoply of other limitations that apply to banks that I don't think are as strictly applicable to stablecoins, to take the particular example of the President's Working Group report, or to the broader question of technological advancement in financial transactions, that I think certainly in the early periods of companies innovating that we should be lumbering these companies with, and that we don't have to lumber these companies with. I mean, we talk a lot about regulation, but I think one of the real problems that banks face in innovating, set aside the whole innovator's dilemma, is certainly the large banks. It's very difficult for them to innovate the same way it's very difficult for any large company to really do innovation. But the supervision of the banks, quite separate from the regulation of the banks, the supervisors will always say they're fully in favor of innovation, but they're very uncomfortable with experimentation, and they punish even small failures. And that's not an environment in which innovation can happen. So if we insist that from the outset, any development of these new technologies has to happen within a regulated bank, which I think, with regard to stablecoins, the President's Working Group would suggest, I think that would be a mistake. We need to identify what our concerns are, identify what limitations will address those concerns, and then let the private sector ecosystem work itself out, whether that happens in banks or outside of banks, in partnership between the two parts of the ecosystem has been suggested. I think we should leave that to others and not be quite as restrictive as the PWG report would suggest.
Just to quickly come back to you, I mean, as someone who's been involved in the international side of this and the challenges involved in that, is it even feasible to be talking at this relatively late stage about that kind of regulatory burden around stablecoins? I mean, is it actually rather fanciful to think you could do it in the first place?
No, so I think it could be done. That's one of the things that concerns me, is that I think that it could, you say a relatively advanced stage. There's a lot of work that's been done, but I think there's a lot of kind of development and further sort of elucidation of use cases for this technology. I think that even 5 years from now, assuming that we allow the technological advancement to continue and that we don't prematurely try to force it into a sort of Procrustean regulatory bed, I think there's a lot that still can happen. But I think it's very possible, and certainly a strong desire, not just with the PWG report in the United States, but even the desire to sort of limit the growth of stablecoins outside of a bank regulatory framework is even stronger outside of the United States, particularly in Europe. Part of that stems from the fact that certain threads of the European discussion view this as just another example of American tech firms colonizing the rest of the world, and so they'd like to just shut it down. And that is a big part of the enthusiasm for central bank digital currency that's grown in Europe over the last few years.
Era, of course, as part of the debate is about which regulator would take an interest in this, and that depends on whether you think they're currencies or securities. I know that my former colleague from my previous days at the US Treasury, Gary Gensler, thinks that stablecoins potentially need to be regulated as securities. He's worried about potential fraud, investor protections, consumer protections. What do you see coming down the track from the SEC standpoint?
Yes, and very happy to be here with all these esteemed panelists. But I do also wanted to recognize the situations of last week, and they're underway, and mainly because probably everybody saw also headlines that donations are being made in crypto. I think that the fact that sanctions are coming down are cutting off banks from the SWIFT program process that really reduces the bank's ability to make international payments. I think that we may see different ways whether the crypto is going to be sort of, embraced for, force for good, or, it will be vilified really. So I do think that regulatory, I mean, like regulating capital markets and financial systems is very important and very topical. And, and then as a very proud former, SEC regulator, I really think that the job that the regulator has is a really difficult one, especially when it comes to the SEC, because like trying to figure out the role of implementing rules around crypto, particularly stable coins or DeFi, is really not very easy. And probably Randy can relate, but in my experience has been that regulators tend to be more reactive than proactive, and particularly in the space of digital assets with all its iterations. Which is distinguished by a very sophisticated technology component, which moves and evolves very fast. And you don't keep track of what's happening in a matter of days. The information can be already too old, or the technology has already advanced, and people have thought of new ways to create value, to arbitrage, to invest and create more yield without that central intermediary, which is believed to to create more friction and slow down the process. So really the challenge for the SEC at least is trying to understand where its jurisdiction lies, especially where these products cross jurisdictional boundaries. So it can be very difficult to understand the scope of what they really need to try to regulate around, because the scope seems to be shifting, every day as technology introduces new elements that make a particular instrument look, like today looks maybe a crypto, and then today you have new features that make it look more like a security. As I will discuss a little later in the context of, like these lend products with the most recent SEC enforcement case, the lines between what's a loan versus a debt get blurred. And there's also tremendous uncertainty as to whether there is even an identifiable legal framework for the user to be protected under. So the need for regulatory clarity has become paramount, as this technology has enabled anyone to trade and have access to such instruments in investments without the need of an intermediary. And as we've seen being the case with the Robinhood platform. And there is absolutely a heightened concern at the SEC about retail investor protection. And many market participants are looking for guidance, and they get frustrated because a lot of smart innovators want to move and charge forward. And even though they're trying to do the right thing legally, their timelines and timelines for their product innovation does not necessarily match that of the regulator. So SEC has tried to put some guidance out there on how to analyze digital assets in determining whether or not they're securities, has published some no action positions, and continues to make statements through the various chairmen and other public officials, but that simply has not been sufficient. Even though the SEC has always been of the belief that their existing rules and regulations are very flexible and adaptable to all iterations of financial instruments, but the reality has been proven them wrong in more than one occasion, I would say. And an example of that has been the struggles that the SEC and FINRA have had in coming up with a solution to the custody of digital assets securities that would enable a broker dealer to fulfill their custody regulatory requirements. And obviously, this, as you mentioned, Stephanie, this is a place where Chairman Gensler is very focused on it. It's a priority area for him. Just last August, he called the crypto space the Wild West. You see the different commissioners having disagreements on the role of the SEC in regulating crypto. Commissioner Pierce has been advocating for a while, in contrast to the others, for safe harbors for digital assets, and that certainly also has contributed to delays in finding a path forward. And then you have the enforcement arm that has been extremely active, with Director Grewal also saying that he's going to basically also pursue gatekeepers. like the auditors and the lawyers and the underwriters and hold them accountable, as he considers them to be the first line of defense, more often than not, against all, types of misconduct. And Chairman Gensler also made it clear that the SEC will not wait on Congress to act and taking an active role in enforcing, activities related to stable coins if he feels that there are violations of securities laws. We've heard it for a while now that new regulation in this space is going to come down, but really the most meaningful impact that the SEC has made as of recently, especially, or where they have really stepped out their activity, has been the enforcement space. Most meaningful was just a week or so ago against one of the DeFi platforms, where the SEC found them to have violated several sections of securities laws and imposed a penalty of $100 million. So basically, the SEC determined that the lend product was a security, should have been issued pursuant to a registration statement or to pursuant an exemption, and also, made the determination that there may have also have been a violation of Investment Company Act, because the company, the DeFi platform, was really behaving like an investment company, holding a large number of securities. Um, so I believe that, at least in the foreseeable future, I would say that the rest of 2022 will see a lot more activity from the SEC in the enforcement space. I think that to some extent they will be tempered depending on the developments that will come down from, the Fed, as we're seeing actually, on how the stablecoins will fit the broader financial regulatory framework. And, lastly, I want to mention the NFT space, which had, a huge boom in last year. However, the ways that at times as NFTs are viewed as investment opportunities with trading and liquidity potential, may not necessarily be looked as collectibles that people hold for a period of time. That could also be an area where the SEC may focus on, in the years to come.
Well, Mike, I suspect, you're sitting in San Francisco, and I suspect you don't necessarily take Wild West as an insult, but how much do you think even this kind of conversation around investor protections, or kind of traditional way of thinking about financial regulation, is that just misplaced in response to this kind of innovation? Should we just be thinking about it a different way?
No, and I don't think it's the Wild West either. I think there's a significant misinterpretation or misrepresentation of blockchain, and it comes around education of what the technology is. I'll give you a couple of good examples. So, late last year, we did a seminal transaction at Figure, where we had a group of Figure employees and Figure investors take their stock and put it up for offer in a limit order book marketplace. So every Figure employee, every Figure investor has their stock in their own digital wallet. And we had a set of institutional buyers come in and bid on that stock. And for 7 days, 24 hours a day, we ran an open marketplace where those bids offers crossed, they settled instantly. And it was seminal on a few fronts. It was the first time anyone's run a marketplace for blockchain securities. So we did that through our broker dealer and our ATS exemption. That's very specific for our ability to actually operate those marketplaces. There's a bunch of nuances in the form that the broker dealer can't take custody or control because of the SEC direction around that process. But we administered that marketplace and effectively ran that 24/7 liquidity pool. There's huge value to that from a regulatory standpoint, because if you think about how private securities traditionally trade, it's very opaque, it's very over the counter, there's no information that's available. In this construct, everyone has the same data. Everyone can see where the stock's trading, they have liquidity, they can go in and decide to participate or not participate, and the regulators can look at this, and it's done within a walled garden construct. Every participant in that marketplace has been KYC'd, which I'll go into in some depth in a separate degree. But this is a huge benefit over how we've traded private stock traditionally, from a safety and soundness standpoint and from an investor protection standpoint. And so the other aspect of that transaction that I think was seminal was the institutional investors in that transaction bought stablecoin directly from New York Community Bank to participate in that bilateral marketplace. Obviously, any participant that bought stablecoin and any participant that received stablecoins, those wallets were KYC'd. And so you had control in terms of participation within that marketplace. And then there was passporting for accreditation to the extent that you needed that as well. And so you created a construct that is a significant leap above what we've done historically across any dimension you look at, across the way that the transactions were funded, across the way the transactions were traded, the transparency and information delivery in the marketplace. And what's happening is we're now seeing more and more secondaries pop up, and you're going to start seeing once a week every quarter or twice a week every quarter a set of companies on the private side pre-IPO creating these liquidity markets where at some point they'll say, as they go public, why would I delist off a T instant exchange onto a T+2? And you're going to get a migration as to that market activity. And it's not going to be a DTC centered marketplace anymore. It's going to be a T instant bilateral marketplace, but that can be done in a way to adhere to the current regulatory requirements. I do worry a lot about the regulators as it relates to public, open source, decentralized chains. And blockchain needs to be public and open source. A permissioned blockchain would be better served as a database. It shouldn't be a blockchain in that construct. And there's a huge amount of value of a public open source chain in terms of your ability to connect in, the ability for third-party development to create value off of that, and the decentralization aspect of not having any central entity of custody or control that can affect the outcome of a marketplace or a transaction or what have you. What I worry about is the regulators are looking at public open source chains and saying, well, we can't ensure that the validators on these chains are all good actors. So how do we know that the validators aren't a terrorist organization or someone who's sanctioned or what have you? And what I think people are missing through this is two levels of concern that we have. One is the Web3 is analogous to the internet. We're on the internet right now. We're all talking. There's lots of nefarious activity that's happening on the internet. It doesn't preclude us from using it in the context of this video call. And so we need to think of the blockchain and Web3 in particular as this ubiquitous technology of which we can build walled gardens within. The other aspect that's disturbing to me is obviously there are big money center banks on the blockchain today, and they're doing things on Ethereum and other platforms that are public platforms. And what the regulators have suggested is they said, well, we'll grandfather them in. They can continue to use the blockchain, but new banks won't be able to use the blockchain. To me, that's a clear situation where the regulators are going to pick the winners and losers of this, because you will need blockchain as an underpinning to your technology efforts over the next 5 years if you want to compete. And if you're precluded from using that technology, you will not be able to compete. And so the idea that the regulators will say the money center banks can stay on it and everyone else won't is kind of a death knell to community and regional banking. And I think that's not what their intent is, but that's what the outcome of that action will be if they take that path.
Randy, I wonder how much you would sort of take that basic approach in considering this. And I'm smiling because there's one of the questions that's come in is from someone who says, I'm completely agnostic about the technological plumbing as a consumer, but as a former regulator, I'm puzzled about the assertions that we should embrace a financial system that does not rely on trust. To regulate effectively, I need to be able to control risks, both micro and macro, and rely on players having skin in the game. I'm not sure that's what Mike said, but what's your response to that?
Well, so I'd say a few things. I mean, replacing Mike's motto of replacing trust with truth. I do think that this new blockchain technology offers a lot of opportunity for improvement on the existing system, and some regulators see that. So when we first engaged on the stablecoin question a few years ago, and that was in the context of, people were the international system looked at it and decided that crypto assets, of any flavor, were just never going to be big enough to pose a financial stability risk that was worth our attention until Facebook came out with Libra. And so then there was a great deal of focus on the possibility for rapid scaling of this technology. And the most skeptical at the outset was law enforcement and the anti-money laundering folks, and saying we have to know, these crypto assets are all anonymous. We have to know the actors. My instinctive reaction was, well, just given the nature of this technology, it ought to be possible to solve for improved transparency as opposed to, anonymity. I mean, Bitcoin and others had been, seeking to solve for anonymity, but you ought to be able to use the technology to solve for better transparency. And at the end of that process, there are certainly stablecoin constructs now that the anti-money laundering regulators are enthusiastic about. Not just resigned to and not just accepting of, but saying this is better than what we currently have. So I think there are ways for this technology to really address some of these regulatory concerns in a superior fashion, and doing it, as Mike said, by replacing trust with truth, just solving the regulatory problem in a different and in some respects superior way.
We're going to run out of time, and I know we've actually got quite a lot of things to get through. So I'm going to try and sort of be, and it's difficult because it's a difficult issue, but to be as brief as possible. Can we just quickly check on a term? I mean, decentralization, that is used a lot. Decentralized finance. Alistair, quickly to you. What does that mean when we think about the future of finance? What do you think of when you think of decentralized finance?
Well, I think it's and it's fascinating hearing two far more learned gentlemen than I am on these very complex matters. Although I have to say, having been a coincidental fintech for 21 years, I remember similar conversations about the infrastructure of sort of Web 1.0, and then the same in 2.0, and certainly in the payments world. Everyone said you'll never replace a tandem box that runs the ATM networks with blade frame, but then it was changed into blade frame, and we went to the cloud. And so I think we see these cycles and we see these shifts, and of course there's many motivations for people to promote particular technologies or platforms or standards. I think decentralization is, we've seen examples of that in emerging markets. If you look at M-Pesa in Kenya, the ability for people to run a mobile money network, taking a country that had 10% of its population banked up to 39%. That's where technology can have a really big impact. And in that particular scenario, you had a bank, Standard Chartered, at the back end, but then you had a mobile network that was the distribution partner out into the townships where people were buying airtime. That was their currency. That's how they got access to it. And so when we talk about decentralization, we're just talking about more actors in the supply chain. Do we need the banks to be in control of the whole end-to-end process? And as I said earlier, I think since the global financial crisis, that's not going to happen. I think regulators, particularly here in the UK, where we have the FCA, which has a mandate for both Prudential Authority and competition, so you've got a carrot and stick. I don't think we are going to go back to a world where we trust, to use Mike's comment, the central clearing banks to do what's right by everybody in the pace it needs to happen. But the flip side of that coin, of course, is when you have massive tech fins like the big advertising platforms who have 1 billion users coming into financial services, and of course adopting some of the technology that we're hearing about today, then I as a regulator would be saying, well, how can I have trust for you? How can you be the custodian of all of these consumers and their money? So it's got a long way to play out. Decentralization of finance has been going on for thousands of years, from bartering over cheap through to Bitcoin. So I don't think there's going to be a silver bullet.
Era, have we had any clarity from the SEC about what they consider to be decentralized finance?
Yeah, so this is a very crucial concept for purposes of securities laws, because finding an asset or a network to be decentralized, meaning that you are not basically going to be within the jurisdiction of the SEC. And unfortunately, there are some pronouncements that the SEC has made, the first one coming from then CorpFin Director Bill Hinman, when he said that if the network and the assets that are on that network is sufficiently decentralized, then those assets may not be considered to be securities under what's called the Howie Test. Is a very old case law that created the framework around analyzing a particular instrument and determine whether it is an investment contract, i.e. a security. And then later the SEC put these guidance out there on how to really analyze digital assets for purposes of determining whether or not they are securities. And what was said in that guidance is that, in order for somebody to make an investment and expect a return on that investment based on the efforts of others, which is sort of, like the summary of the Howie test, it contrasted that with the decentralized network, which is the network they define it as an unaffiliated dispersed community of users. However, just by using that nomenclature, the SEC has not been shy in terms of bringing enforcement actions. Just last August, they brought an enforcement action against a DeFi platform that basically issued securities on this decentralized network. And basically, it was a way for the SEC to say, we will go and look underneath the hood, if you will. And just because you're calling the token a governance token does not mean that that's not a security. And we've had other pronouncements by particularly Commissioner Cranshaw that said that the SEC has a very significant role in regulating DeFi's, with one reason being that the SEC focuses on the fact that consumer fintech apps made crypto so highly accessible to retail investors. They don't really fully understand what they're trading. There is only a relatively small group of people, as she indicated, that can actually read and understand the code, and even highly qualified expert may miss certain things, or basically flaws in the system. And we have seen the market move towards this sort of like structure of creating a DAO, or issuing these governance tokens. But there's certainly questions around what does it mean to be sufficiently decentralized, and that's a question that the SEC has not really fully answered. And unfortunately, when we look at past history, the SEC waits about 2 to 3 years before bringing in enforcement actions from the time when the conduct began. So I really do hope that we get a lot more clarity, because we see the emphasis on decentralization from sort of the old and new innovators coming into the space. So I do think that more clarity from the regulator, especially the SEC, would be very useful.
Well, Randy, I want to go back, because this is a sort of major topic that we haven't touched on that some of the questions relate to. So your favorite topic of central bank digital currencies. I noticed that actually just a few weeks ago, the Fed put out a working paper that I guess was a follow-up in a sense to the president's group, but specifically on the pros and cons of having a central bank digital currency. It seemed quite positive. And the two things I'm interested in, whether you agree, the strongest arguments for it seem to be, in the working paper's view, was that if you're going to a cashless world, you need the public to continue to have access to some kind of central bank liability if there's no cash around. And the second, which I think relates to this regulatory issue, was that if you have a digital currency, a digital central bank liability, you don't have liquidity and credit risk to worry about. So that's a kind of firmer foundation for innovation in digital payments than private stable coins. There's a lively argument in the Fed about whether to do this, but what do you think about those arguments in principle?
So with respect to, so the first argument I consider sort of well, both of those arguments I think are a little bit, desperate isn't exactly the right term, but they're sort of manufactured. The original impetus for the central banks around the world considering a central bank digital currency was, again, Facebook's announcement of Libra. Just a few months earlier, we had completed at the FSB a review of crypto assets in general, and including stable coins, and concluded, this is fine. There will be some issues, but it's not a big deal. But Facebook announces Libra, and suddenly there are central banks and finance ministries around the world saying we can't have a private company issuing money. Only the state can issue money. I mean, this is an incoherent thing to say. Almost all of our money is issued by large private companies. Very little of the money we use is actually issued by the state. The national security folks then, a couple of months later, China announces they're developing a CBDC. And the national security folks, particularly in the United States, lose their minds. We have to keep up with China. This is a threat to the dollar. That is no more a threat to the dollar than if the Chinese decided to print the yuan on purple paper. The basis of the dollar as the world's reserve currency is not threatened in the least by a CBDC, by China's having a CBDC. So now the central banks of the world have said, well, but we've got to do something. So they're coming up with increasingly, I think, weak arguments. So the first argument you mentioned is sort of a blood and soil argument, that the consumer must have some connection with the state in order to be able to trust their money. Well, I don't trust my bank deposits any less than I trust the little pieces of paper in my pocket that I use only to pay tips. That's not a thing. And some of the other arguments that are put forward about financial inclusion, there's no way to make a CBDC a useful instrument for financial inclusion unless you're disintermediating the private banking system and having a direct relationship with the public to the central bank. And disintermediating the private banking system means, it inevitably leads to the politicization of credit, because those funds will have to be re-intermediated somehow, and that will come with strings, whether they're re-intermediated directly by loans made by the central bank, or the central bank gives the money back to the private banking system to allocate credit, but that will come with strings. So none of the arguments that have been put forward for a CBDC strike me as good at all. And so you might say, well, suppose they're not good arguments. What does it hurt? It's kind of fun. It seems like the future. They couldn't give us jetpacks. Maybe they can give us digital money. But there are real risks that are associated with it that I think are not attendant on private stablecoins, and all of the benefits can come from private sector innovation.
Well, all I can say is it's a great window we're getting onto that lively debate on the FOMC on this subject. But I'm very glad that you're now out of the Fed, so you can be so candid about it. We are going to run out of time very quick, but I want to come back with you with one question from the audience, and then I'm going to come back to Mike again to pick up on some of these things. But there was a question specifically around the central bank digital currencies that if central banks do create their own digital versions of their fiat currencies, will other currencies such as stable coins still have an advantage in major markets once there's a digital dollar, euro, renminbi? Just quickly on that to Randy, and then I'll go on the broader point to Mike.
So I don't, will other central banks inevitably need to follow? I don't think so. I think that many central banks will now implement a CBDC. I don't think that the Fed can legally without congressional action. The Federal Reserve Act has certain requirements for obligations that the Federal Reserve issues that can only be satisfied by a physical instrument. So I think you'd need a new law, and I think it will be hard to get a new law.
Would it be competition, though, for stable? If you start to have these big central bank digital currencies, is that actually direct competition for stable coins? I think was the question.
Is it direct competition to stable coins? Yes, I think it would be. I think it would be. I think that would be competition. I don't think that it would be sort of foreclosing competition, just because the central banks will always be less fast and less innovative than the private sector. So, private sector stable coins, they won't have as big of a market, and so there isn't as much scope there. But there's still scope, and they'd be able to sort of produce a better product than a central bank, for example. That was one of the reasons why I opposed the development of FedNow, which was just, by the time we get this done, the technology will have moved on. This will be a white elephant. The private sector will do this much better and faster than we can, and I think that's being proved as we speak.
Mike, just to come back to you on some of these broader issues. I mentioned the working paper from the Fed, and one of these arguments was there's too much liquidity and credit risk for there to be a good foundation for innovation in digital payments, or at least that you can allow for more innovation if you get rid of that and have the central bank digital currency. I suspect that you might be skeptical of that argument, but there is still that risk that's there. With one of these transactions, if you haven't got a trusted intermediary in a decentralized context, that wouldn't be there with a traditional financial institution. So it's important for consumers to understand that, right?
Yeah, I mean, well, first I want to reinforce what Randy said. I think a central bank digital currency is a huge existential threat to the private banking system, and in fact would probably cause a massive transformation. In fact, probably the termination of the private banking system over the course of 10 years. So it's a very dangerous thing if you're a bank. But in the context of trusted intermediary, I think back to the discussions we had when we were getting our broker dealer with FINRA, and we were explaining how blockchain works and how both parties have to encumber their transaction to be able to consummate the trade. So, if I'm trading stock, the stock has to be in my digital wallet. It has to be unencumbered. The stablecoin has to be in your digital wallet. It has to be unencumbered. And we cross, and the blockchain does that real time settlement with no counterparty or settlement risk. And the person going through our application said, "Well, what do you do when the trade breaks?" And obviously, in the context of blockchain, it's a false dichotomy. The trade can't break, and I made the mistake of saying that. And the person said, "Look, I've been in this business for 30 years, and trades break, and don't tell me they don't break, buddy. And I don't know, come from California, you know what you're even talking about." And so we created an administrator that sat on the blockchain under the auspices that if anything bad ever happened on the blockchain, you'd call the administrator and they could fix it. I'm not even sure if they were able to do that, but that's what we said. The administrator would be able to fix it. And over the course of 3 years, no one ever called the administrator. So then we were able to get rid of the administrator and say this is truly public and decentralized, and there is no intermediation. The aspect of intermediation, the aspect of what do you do when this breaks, what do you do when the money goes the wrong place, et cetera, it's a false dichotomy in the context of blockchain because it can't happen. And I can go into elaborate details about how this works in payments, how it works in security transactions, how it works in token transactions. But at the end of the day, that can't happen. Now, lots of other things can happen, like you can lose your private keys. And we've all heard the story about the guy who's digging up the garbage dump in London trying to find his $50 million of Bitcoin because he lost his private keys. That's real. But the idea of transactions breaking or needing trusted intermediaries to escrow, that whole point of blockchain is you blow that out of the water. You don't need that.
Do you think, just going back to the discussion we had around the definition of or the Howie Test and some of this kind of definition of decentralization, from your perspective, does this 1933 test still make sense as a way to think about tokens?
Yeah, I think the way to think about it is really in two camps. There are clear security transactions on blockchain. So, for example, our trading our private company stock, those are securities. There's no way that we can argue those aren't securities. And the issue with the token, the way that proof of stake networks work is you buy that token to pay for gas fees. And the more transactions that happen on the blockchain, the greater the value of that token, because the token is going to reflect the present value of the gas fees that you'll pay in over the life of the chain. And so, of course, there's an anticipation that as adoption increases, the price of that utility token will increase. Does that make it a security? Well, if I know that there's going to be a run on aluminum production and I buy aluminum in advance of that, is aluminum now a security because I anticipate it'll increase in value? If I know that there's a geographic or a migration to a particular geographic region and I buy property there, is the property a security because I anticipate it'll increase in value? And, there's some challenges around the Howie assessment in terms of expectation of holding. But in general, that's what we have right now, and that's what we have to work to. And that's why it's very important. A lot of the ICOs that were done, it was clearly a security offering that was guided as a utility token, and there's a lot of issues that will come out of that. But I think in general, it's what we have right now. It's what we have to adhere to, but it certainly has some flaws as it relates to blockchain technology.
So we have a question for Al, which is, although I suspect you could all have a view on it, but what would you like to see from regulators in order to allow for fair competition between banks and fintechs?
Well, look, I think we've seen, and thank you for teeing up, because I think it's the key point. You've got so many smart people, I'm sure in the audience and on this panel, talking about the technology and the regulation and cryptocurrencies, but there is a fairly fundamental framework that has worked certainly in Western civilization, which is that consumers vote in politicians, politicians tend to guide regulators, and things need to make sense to need to make sense to people. And in the UK after 2008, we had this very open, collaborative dialogue going on between the regulator, the FCA, through Project Innovate, and the incumbents, the big banks, who came reluctantly to the table initially, but actually now, get a lot out of the dialogue. And then cohorts of fintechs that come through the program and share their thoughts. They learn a lot because they turn up thinking the banks are dumb and stupid and can't get anything done, and they say, "Look at my sexy app." And then they realize that actually, it's complex running it. It's fine for one person, but not for a million. And so, but you do get this quite interesting ecosystem, and it's been. I mean, I've watched Randy's incredible contribution to this debate stateside. One of the advantages we have in the UK is we do have one regulator. We don't have 50 states. We don't have national and state level regulation. You don't have New York kind of saying, "Well, we are Fin," and then California saying, "Well, we are tech," and we'll never meet in the middle. We do have quite a collaborative ecosystem, and one of the things that's been so successful in the last three industrial revolutions for the UK is the setting of standards. Is the ability in the City of London to say what is the standard for a particular currency or the minting of a coin. And so I think the exciting thing for me out of this dialogue is, where are the standards going to be set, whether it's in the blockchain or particular coins, particular currencies? How are we going to get collaboration and agreement? Because that tends to then lead to mass market adoption. Otherwise, we started with the mention of the Wild West. As we know, it was the picks and shovels that made most of the money on the journey to find the gold. What we do need is, we need some collaboration around standards, because then you get education and you get adoption. So I think most of the banks that I know, most of the CEOs of banks that I know, are very open to conversations now, whereas they weren't 15 years ago. They thought they owned the supply chain. I think the regulator could play a really interesting role in having a more collaborative dialogue amongst fintechs and the incumbents, and that could lead, as we've seen with Project Innovate, certainly in the UK, to some solutions rather than endless debates about it. But that's a hope, probably a political, probably an emotional one with where the world's at the moment as well.
Well, Alistair, notwithstanding the caveat about the current state of affairs, I really appreciate those rather wise and positive words to end this session on, which I'm dying to see what this artwork looks like. But it certainly, I feel like we've, yes, that's exactly what happened. I think that looks exactly right to me. But I look forward to studying it in my leisure. And in the meantime, I appreciate the questions from everybody. There's been some really excellent ones, and I'm sorry if we couldn't get to all of them. But in the meantime, I'm going to pass back to Doug, but just thanking Mike, Randy, Alistair, and Era for these great contributions. Doug.
The panelists, Alistair, Mike, Randy, and Era, covered a lot of ground, and I'm sure we could have covered more and more had we had more time. To the audience, if we were unable to answer any of your questions, please feel free to reach out to me. We will follow up. In addition, a recording of this session, as well as the artwork, which you can see neatly summarizes the key points raised during the webinar, will be sent to you in the coming days. We hope that you'll webinars that we have on energy and transition and globalization, changing dimensions in international trade, and one on the role of ESG in transitioning to more sustainable supply chains, which will be advertised on our website. Thank you once again for joining us on this challenging day. We would appreciate your feedback on this event, which you can give us using the form on the closing screen.